Alright legends, so this is going to be a very quick tutorial on the unicorn model, ICT's unicorn model, and how you can work with this to enhance your trading and just to get a better understanding of how price is moving. So first things first, for every ICT trading model, time is always the most important factor between time and price. Some models only appear during macro times and some can appear anywhere in the kill zone. And the unicorn model appears in two kill zones, that is the London kill zone from 2 a.m. to 5 a.m. EST, and the New York kill zone, that is from 8 a.m. to 12 p.m. EST. So the setup is very simple. Price has to be in motion towards a draw. There has to be a big breaker block leading towards a sweep of liquidity. When that sweep is done and price reverses, you can think about the fact that yes, maybe this is a unicorn forming. So after the sweep, there has to be a displacement to the opposite side. That means a fair value gap that overlaps with the breaker block that led to the sweep. So the fair value gap overlapping the breaker block that led to the liquidity sweep. So these are two perfect examples, one bullish and one bearish. So let's talk about the bearish example. You can see here the price leg that comes before the liquidity sweep is marked between the ones right here. So the ones are just a bullish order block for now because the setup is in the future, so we really don't know what's going to happen next. If and when price reverses after sweeping the liquidity, it pushes and displaces downwards, creating a bearish fair value gap right here. Price might or might not retrace back here. As you can see, this leg came back, so price might or might not retrace back to go lower towards the next draw. So this is the chart of NQZ 2025, 14th October, which is 2 days after the tariff nonsense that Trump just talked about, China and imposing about 150% of tariffs on China. So zooming this here a little bit. So this is the 15-minute chart. As you can see, 9:30 a.m. on 14th October. So you see here on one, there are two bullish candles indicating a bearish order block that leads to another huge red candle right here. Liquidity is swept on two and price shoots upwards, creating a fair value gap within the breaker block. Now, price moved away from this fair value gap and there was no retracement. But usually there is a retracement into the bearish order block or the fair value gap. Either one or both or none, as you can see, as price was really bullish at this time. So this is another example. On the 1 minute chart, there is one bullish candle right here, the bearish order block. Price came here, swept liquidity, that's level 2, and then third, overlapping fair value gap within the breaker block. Here also there was no retracement, so entry on this would have been a little tricky, but this is a really good example of an A or an A plus setup for a unicorn model. So the earlier chart, I put that chart again zoomed out a little bit on the 5-minute chart. Here you see again the bullish candle right here, the order block leading to the sweep of liquidity, and then this creates two fair value gaps, one within the range of the breaker block and one outside of the range of the breaker block. Price on this candle comes back, retraces into this fair value gap and the breaker block that led to the sweep of liquidity. So this would have been an A plus entry, leading to the next draw on liquidity right here. So that was a very simple explanation about ICT's unicorn model. Appreciate you sticking around, and if you got some value, just leave a comment or something, and I appreciate that. Peace.